Good evening, everyone, and a very warm welcome to today's webinar. We are going to talk about practitioners' insights in passive investing in domestic and overseas markets. My name is Jolly Balwa, and I'm going to be moderating this session today. I have an experience of over 10 years in the financial services industry, and in the last few years, I have been associated with the Bombay Stock Exchange. Now, to provide you with a bit of a backdrop to today's topics, we are going to focus on two key developments in the Indian equity investing landscape over last few years, I would say 4 to 5 years. So the first one is passive investing or passive funds, which have actually come a long way in the global markets. And especially if we look at the US markets, they now account for almost 50% of the equity funds being offered over there. Also in India, in the last 5 years, they have grown substantially. And I think as of earlier this year, they account for almost 10% of the AUM of equity funds in the Indian mutual fund industry. And that volume stands at around, I think, 3 lakh crores in India. And this is also slated to grow to 7 to 8 times of this volume in the coming 4 to 5 years, as per various estimates. So that is the first topic. And the second one is the global investing. Now, global investing has also grown in popularity. And now we have various investment vehicles and even some low-cost funds, which are truly democratizing the access to global equities for the Indian investors. So let's have a detailed look at both of these topics today, along with our guest speakers from Motilal Oswal Asset Management Company. Before I introduce our guests for today, let's have a look at the housekeeping notes that I have to share. Anlin, if you could change the slide. Thank you. So today's webinar is scheduled for around 60 minutes, including Q&A. And we welcome your questions throughout the session. And you can submit them through the Q&A button on your screen. And there will also be an evaluation survey towards the end of the session. So we welcome your feedback, and please do ensure that you fill it up for our feedback. Thank you so much. Now, I would like to introduce our speakers for today. We have with us Mr. Vikash Wadekar and Mr. Mahavir Kaswa. Vikash is a veteran of the mutual fund industry with over 2 decades of experience. He was instrumental in setting up the BSE Star MF platform, and he has also spent extensive time at the Benchmark Mutual Fund, which was a pioneer in the Etfs and indexing in India. Currently, Vikash heads passive funds sales in Motilal Oswal Asset Management Company. And Vikash also has a postgraduate degree in management from the Pune University. So welcome, Vikash. Apart from that, we also have Mr. Mahavir Kaswa with us today. He is the VP in research for passive funds at Motilal Oswal Asset Management Company. He contributes on the investment strategies, new product ideation, and even promotes passive investing. With an overall experience of 15 years, Mahavir has earlier also worked with the S&P Dow Jones Indices as a product manager. Mahavir has a master's in commerce from Pune University, and he's also a CFA charter holder. Welcome, Mahavir. And over to you, Vikash and Mahavir.
Thank you, Jolly.
Yeah, thank you, Jolly. Thank you, Annalyn and Kunal, for arranging this, and welcome all the participants, and thank you for giving us this opportunity. Today's session is going to be, for all analysts, this seems to be a kind of raising their eyebrows. What are we going to talk about? Okay, is it really happening? Yeah, so we have some data. We'll try to substantiate few things. We can also have a good discussion on this. This is a discussion topic. Definitely, we can. If you guys think that a few things are not completely covered here because of time duration, we can always come back to you with the data. So let me begin with an interesting light. Okay. Just watch carefully. I'm going to ask something post this.
Nowhere is the frenzied energy of Bombay business shown more than here at the stock exchange. Brokers pray for luck just to survive as they enter the human maelstrom of the trading floor, now the busiest in the world. This is share trading as it used to be, where brokers are elevated to the status of cult heroes and regulation spurned. For 2 hours every day, broker Sundar Iyer is crammed onto the trading floor.
Tell us, what are all the hand signals? What are they for? That means we were buying at 85 and we are selling at 87.5. Two-way code.
What's it like though at the moment out there on the floor? It must be tough. You're getting pushed and shoved. Does it get violent at times?
Yes, many times when there are very volatile scripts, it does go beyond just pushing and prodding. It goes to deep shouting and even fights, hand fights, sometimes it takes place. But that's all part of the game. Yeah, it's all part of the game. And people do enjoy it at the end of the day.
Is it fun?
It's very much fun, I must tell you.
Yes, guys. So I have a question for everyone. What do you think these guys were doing? You saw the video. You can mention put in the chat box. What do you think these guys were doing? Yeah. I really want to, this will actually a trigger point to go for next, to begin our presentation. Any feedback?
I think chat box may not be activated for them, I guess.
Jolly, it must be, right?
They can use the Q&A box.
Yeah. Listen. Trading scripts. Yeah, I think, yeah, we got some trading scripts of exchange, buying and selling stock, trading. Okay. That's good. But why they were actually doing so much of efforts? Do you think that they're trying to achieve something out of it? And is that something related to money? Is that something related to wealth creation? Yeah, that was a ring trading. Yes. Yeah. Okay. Do you guys think that they were? Yeah. Somebody mentioned commission. Okay. Do you guys see that? Is there any role of wealth creation in this video? So people do multiple things for wealth creation, and this is what we have seen one example that, and that's what our today's topic is going to be. Okay, we all of us know that there are various sources of wealth creation, and we just saw one of it. But there are others, like people invest in real estate, debt, fixed deposits, gold, crypto. Of course, people believe in lottery also. Okay, which includes gambling and racing as well. So there are various sources of wealth creation. But out of this, what we believe is, what we can talk about is equities, where we have a lot of data, and this will actually relate to our today's discussion. So we will stick to equities today. How does equity plays a role of wealth creation? So when it comes to equity, what all things people do? We do research, fundamental technical analysis. We also do tips. Okay, somebody told me that this fair is going to run. When there is a teji, so Panwala also tells, okay, this stock, arey sir, ye kharid lo, chalega. Sometimes we do research based on performing stocks. So the last 2 years, 5-year returns are good, so I should be investing. Okay, yeah, people also use astrology. Okay, tarot cards, planetary positions of getting into and getting out of the market. But yes, people also do portfolio investing through PMS, mutual funds. Yeah, there are some in the Indore-based research calls also. Yes. So there are various ways investors and advisors invest in equities. But I think out of all these, today the most of the data, see, people may be money. We are not sure that whether people are actually making money out of all these things. But we have some data available for mutual funds, which is it's a long data which have available. So we can talk about it. So today we will concentrate on one of the proxy of all these ways of investing equities. Yes, if it works here, probably it may work the other factors as well. So what are people trying to do? People are trying to do these ways to get returns, okay, to make better returns, or they're trying to beat something. Okay, and let's see, we have some data, globally published data by S&P Dow Jones. So this is a report which is published by SPIVA every semi-annually, June and December. This is a June 2000. So this is a December 2020 data. So what this data says, all the bubbles which you see, this pertains to the number of this particular country. So let's look at one bubble of US. Okay, this says that 60, 70, and 75. You can see this. So 60 is 1 year, 70 is 3 year, and last is 5 years. So all these columns are same for 1 year, 3 year, and 5 year. What this data says that there is an index called S&P 500 below that. Pardon me for this small, because there's an image we took it from S&P. This is not something we have created. So it cannot be zoomed too much. So what it says that in S&P 500, active fund managers in US are underperforming in 1 year category 60%, 3 year category 70%, and 5 year category 75%. This is applicable to different economies and different markets. India figure is also there. 1 year, there are active fund managers who are tracking BSE 100, which is top 100 stocks, 81%, 88%, and 88% for 5 years. These are the underperformance. That means so many of the active funds are underperforming this index as of this date. So so these are all active way of investing, where you try to do various things to generate return and also to make better return from a benchmark. Now this is globally, this data is present. Let's look at closely about India, how this number works like. This is again extract from the same report. This report says there are large cap mutual funds, S&P 500, S&P BSE 100, which is, this is an index. Again, 86, 86, and 82. I think this is June 2021 report. Okay, so these are the funds. In 10 years, 65% of the funds are underperforming in large cap category, in all active funds. ELSS category, you can see same number. Mid and small, yeah, you can see some outperformance happening, and these are the debt category also. So investors do various things to make returns better than something. And what is that something? That something is called benchmark, or something is called index. Okay, and the number says that there is an active fund manager who does active research and try to do, and we saw other factors also. We don't have data for that. It's actually not happening. Okay, so let's understand why this is happening. Yeah, so there are two styles of investing globally, which are very popular. One is called active and passive. The active fund manager chooses stocks. He does research. He aims to participate in the growth of the stock. So and he aims to beat market. Is something to highlight. Beat market. Okay, which includes all your PMS also, all your portfolio investing, mutual funds. Okay, and there is something called passive, which invest in benchmark. So let's understand why this or what are the style, how does it work for both of these investments. Yeah, so this is something to index. So all these active guys are trying to look at to beat market. Okay, so what is a market? It's an index. What is an index? Index is popularly known BSE Sensex 30 or Nifty 50. You have different indices. We just saw BSE 100, there is NSE 100, NSE 500, Nifty 500, all these indices are there. So all these active fund managers are trying to beat this index. Okay. So what is this index? And why index is so important? I kept it as a benchmark. This is where we get answers. So benchmark is actually single point summary of market wisdom. So who decides that Nifty Sensex is at 60,000 or Nifty at 17,000? It's all participants. So whether you have hundreds of FIs registered, you have 40 plus mutual fund company, 40 plus insurance companies, financial institutions, all put together, and there are thousands of brokers who all put together decide where the market should be. That is called market wisdom. And people want to beat market wisdom. Okay, that's why index has been chosen. Second, it's an ideal for a proxy of broad market. It actually determines who decides the price of a particular security, this entire market. So it's a proxy that where market wants everybody. It is not something that because I may be buyer today, I may be seller tomorrow. But that's what gets combined in the index, and index is ensured. Process driven and remove individual biases. So there is a process, how the stocks are selected in an index, which is based on their market cap, which is size, the liquidity. Also, some of the indices also cover derivatives participation, and then they become part of the particular index. And the idea is to have a broad market coverage where you can measure how a particular market is doing. Okay, so index is something very, very important aspect why being used as a benchmark. So it is not something that very shady things that you can compare any benchmark and try to outperform. Okay, but there is something has happened recently by SEBI. So earlier, what active mutual fund schemes used to do is they used to compare a wrong benchmark. So they may be managing a large cap or large and mid fund, and they may be comparing with a large cap index. So SEBI actually changed that. If your category is large and mid, you have to use an appropriate index. You cannot use a total return you cannot use a price index. You have to use a total return index. Only total return index is basically where you get a dividend also, part of it. Okay, so that has been changed. If they call it a large cap fund, and they used to also invest a lot of mid cap and small caps in that. They used to call a small cap fund, they used to invest large cap and mid cap in that. So all this categorization has changed, and that has made active fund manager restricted and very difficult to beat this index. Okay. So we were talking about a couple of pros and cons. So active investment, what is an objective on active fund manager? He wants to do perform better. He wants to do better return, then benchmark. He wants to do a better risk control, then market. He wants to give a better flexibility than market or market benchmark. Cons, you might see that fund manager investing in too many stocks. Sometimes fund manager does a style drift. He starts with a growth strategy, value strategy, and slowly as the market sometimes doesn't support him, so he changes his style. Fees, higher fees, which are again a challenge, and that's actually becoming a major challenge for active. Now let's look at passive investment. Passive investment, the pros are the fees are very, very low. The transparency is there. You exactly know if I'm buying a Sensex index, that means I am buying 30 stocks in so many weightages. And what you get is a market returns. What do you mean by market return? Index returns or market return is the market wisdom. Okay, so all these hundreds and thousands of intellectual people who are trading in the market, that's what I get out of it. That's why market index are a very powerful concepts. Okay. Yeah, some guys might say, oh, I don't get outperformance, concentration to some of the stocks. Maybe there is a liquidity issue, that's what people think, but liquidity is being already been taken care while selecting a particular index. Okay. Yeah, so let's look at what is the benefit of index investment. So if I invest in Nifty 50, if I invest in BSE Sensex, there are Nifty 100, various different Nifty 500, what do I get? Very, very easy to say and simple to understand. If I don't know what to buy, I will buy market. Okay, you don't have to worry about the track record because there is no fund manager, and track record is used as long as 20 years plus. Okay, that's a very long track record. It gives you confidence, why something may work or why something may not work. Economic, they are very low cost, so there is no fund manager, so you save on cost, and what you get is a market wisdom. They are very, very effective. We just saw a couple of slides where the numbers are very effective. The active guys, in spite of doing so much of research, they are unable to beat the benchmark. Another essential point is the effective asset allocation. When you want to buy a particular segment, like large cap, mid cap, or small cap, or multi cap, index is a true representation of those particular strategies. Okay, so they because they don't have any fund manager bias, so you can actually use it better for asset allocation. Yeah, so here we see when we say passive funds, there are two types of funds: index funds and ETF. So index fund is nothing but it's a normal mutual fund where it tracks particular index. And what is an ETF? ETF is an actual index fund, but ETF can be bought and sold on stock exchange like a shares. Okay, so if I ask you if you want to buy a Nifty in cash market, there is no product available because Nifty can be only bought. I am talking about Nifty 50 or Sensex 30 only can be bought in a derivatives market. But there are ETFs, there are funds which track this index on real time. You can buy and sell like a stock on the market. So this is the difference between index fund. So index fund, you get generally end of the day market price, and ETF, you get a real time market price. So if you are buying at 2 o'clock or 3 o'clock, you get that price. You can actually buy and trade like a stock. That's the difference. Yeah, this is what we covered. So when you want to choose a right passive fund, what you need to do is you need to understand the stability, which risk that I want to capture, what is exactly I want to add. There is a large cap space, large and mid cap space, small cap maybe, and multi cap space. Okay, so you choose a right product. Look at something called with industry average expense ratios are lower the better. Tracking error, we'll talk about it slightly in detail. How closely fund tracks that index, that is determined by tracking error. And AUM, yes, large AUM help to minimize the impact cost, because index fund we just saw, people can use it like a stock or for short-term bets. So you might see a lot of investors getting out of it. Large AUM then affect that fund's return. Yeah. So here's a question. So we just saw major difference in we want everybody to participate. There will be a poll question. So what do you think? And you to answer. So what do you think of impact cost of 1% higher expense ratio in long-term fund? So that's different.
You seems to be breaking. Can you repeat?
Yeah, I think there is a network issue here. So yeah, there is a question in front of the screen. You have to answer. So what is an impact of expense ratio, 1% expense ratio, which is the major difference between the active and passive funds. If you have a 1% lower cost or a higher expense ratio, how much it will affect your portfolio? So we expect participants to answer. If we don't get answer in next 15 seconds, then we'll move forward. Okay, so have we got any answers? Wow. Okay. Portfolio less by 10%, yeah, 44%, and portfolio less by 30. Okay. Wow. Okay. So this is what we get. Yeah. Mahavir, do we have answer on the next slide?
Yes.
So shall I move forward?
Yeah. Can you close the poll window? It's showing up on the screen.
I've closed, right?
Yes. Yes.
Yeah. Okay. So you can see if there is a 1% expense ratio higher, it affects in 25 years, which we talk about longer term, 28%. Okay. So those guys who mentioned about 25 to 30% are the winners. Okay. So it's a huge, it's like a iceberg, which we see very small in above the water level, but underlying it actually eats away your portfolio. Okay, so that is
An
the
eye
major
opener, Vikash. It's a huge difference and quite an eye opener, because usually we don't tend to think in terms of long-term basis when it comes to cost savings. We only calculate compounded returns on a basis of 10 years or long term, but we don't focus on costs. But this is really an eye opener, I would say.
Yeah, and these are not only expense ratio costs. There are a lot of other costs, which other factors also will be covering in further slides. So don't think that if you are buying and selling stocks, there is no cost. There is cost. Okay, so this applies to all your active mutual fund as well as the active strategies. What you do, higher you churn your portfolio, higher you buy and sell, that cost eats away your returns, and longer term it affects a lot. Okay, so this is just a simple format we try to put it across here. Yeah, so we just saw something called a tracking error or tracking difference. So how a good fund manager or a good index fund manager will be able to give you very close returns to a index. Okay, so there are something called two difference. One is tracking difference, tracking error. So tracking difference is if you see 1 year return of a particular fund, it's an index fund versus benchmark, you see, suppose there is a 1% difference, for example. Okay, so that is called a tracking difference, because you are looking at a particular date, maybe 30th September, maybe 31st of October. So 1 year, there is a difference of 1%. Okay, so tracking difference and tracking error are different. Tracking error are are known as the standard deviation of daily differences. So what we saw in the first example was the 1 year difference on a particular day. Okay, what index of the fund delivered. But the tracking error is something called a standard deviation. It's like a day to like last 252 working days. And if that variation is too much, like here, you can see there is a less tracking error difference here, but you can see the tracking error is huge. Okay, so lower the tracking error and lower the tracking difference are better for a fund. That's how one can choose a particular fund, and all these data is available in the fund fact sheet. Okay, yeah, so we see that passive things are happening globally. It's happening. India also it is happening. Is it something to do with the pandemic? So pandemic, people don't know what to do, so people go to passive funds. It's not like that. It's actually very difficult to beat market because of as market become mature. You just think of 25 years back. We just saw one example in that video that 85 he was buying and 87.5 he was selling. Look at the efficiency of the market, or very, very low. 25 years down the line, we have SEBI, we have all online portal, we have all algorithms. Now the market have become very, very competitive. You can't sell a news. Those days, the particular stock news price used to come after 2 days or 3 days to Bombay Stock Exchange. Some trade has happened in Chennai or Bangalore. Now it happens next second. Okay, it is known to the market next second. Okay, so there is information is become a commodity. Okay, so all information is available. It is no more something for outperformance. So it becomes very, very difficult to beat a market. Low cost, we just saw the cost impact. Systematic risk.
Just to intervene, I have a question on the first point. This first point about hard to beat the market, is this true for all different funds, or is it like mainly true for large cap funds, or how does it actually work?
Yeah, we saw it is actually for all types of funds. So
across market caps.
Across market caps, yes. As market will start maturing, these numbers will become bigger and bigger. So let's take an example. Large cap category, 5 year 82% funds are unable to beat, but small cap and mid cap 67 or 70% are unable to beat. Okay, so as market will start maturing, you will see this number growing. You will see that mid cap also you will see 75-80% funds will start underperforming.
Right.
Okay, and this is not
So
only
as of now, it
mid
is
category.
larger for the large cap category.
Yeah. Okay. But you can see in debt category also this is applicable, right? So there is something called debt also, there are index funds. Okay.
Right.
And question here is not about outperformance, underperformance. So see, there are still in 5 years, there are 18% funds are outperforming, right? But my question is, how do you select that particular 18% also? In mid-cap category, there are 30% funds are outperforming. Right. So today I select a particular XYZ. What is a guarantee that after 5 years, this fund will continue to be in top 5 or outperformer?
Right.
Okay.
Right.
That's where benchmark helps you, because benchmark is almost 70 to 80. See, here when I'm with benchmark, 70 to 80% of the time I'm better off, because benchmarks don't underperform. Indices don't underperform. It is the active guys who underperform and outperform.
Yeah.
Okay. Yeah, so we were here. Yeah. So there is something called systematic risk and unsystematic risk. So what is systematic risk? So tomorrow, another third wave of say coronavirus comes in, breaks in. What will happen to the markets? Markets will fall. So what will happen? If I am an active fund manager, whether my portfolio will go down or not. If you are holding a particular stock, what will happen? Systematic risk is common to everyone. Whoever is in the financial market, any political risk, any economic news risk, any fundamental risk, any technical risk is common to everyone. There is something called unsystematic risk. On top of that, you might see that there are two guys here sitting, me and Mahavir. So if I think that I am very bullish on tech, Mahavir would say, no, I am very bullish on pharma. Tech rally is over. Okay, so this is called unsystematic risk, because there is something fund manager biases. I feel this is right, he feels that is right. Okay, when you go to a portfolio manager, this is another reason why you go. So there is something called a market risk. On top of that, you get a fund manager bias, his likingness, his style of investing, his style drift. Okay, his style changes, all these things affect. That's an additional risk somebody is taking when he goes to active fund manager. Definitely one should take a risk, but that risk should give you returns, but that is not happening. That is the whole point here. Okay, when you take unsystematic risk, it should give you alpha, it just give you additional return. That's not happening. And transparent, yes, you know exactly what you are buying. All the 30 days the portfolio remains same and publicly available. Okay, so that is the beauty. The transparency is very high here. Another question. So what do you think the current share of passive funds in India? Any number? Polls, please. So next 15 seconds. Okay, so can we have the answers, please? Okay, so highest is between 10 to 20%. Let's look at the answers. Oh, so before 2015,
the results are interesting because majority of the people think that it is either between 10 to 20% or more than 30%. So this is the kind of perception that has been formed owing to their popularity of the passive funds, I would say.
Yes. Yeah, so this number, in fact, the flows that we are getting is actually 20 to 30, 25 to 30% also, from direct clients. Okay, that is the same number. So see the growth. Now, especially this growth has, so benchmark mutual fund started first ETF way back in 2001, and first index fund was launched by IDBI. Then various index funds came in, but actually the traction started coming after 2014, where EPFO money started coming in market. Okay, if EPFO started investing, then CPSE came. Okay, all these actually have boosted. So most of the money which you see is actually from EPFO. But yes, there's a share of international gold and debt is also increasing. In last 2 years, the debt passive funds also has got very good traction. Okay.
Because how about commodity? I mean, apart from gold, any other commodities have?
Other commodities are not allowed by SEBI as of now. SEBI has just given approval for silver. Just it is not even a month. Okay, but none of the mutual fund has yet filed. So once they file it, you might see silver ETF coming very soon.
That's interesting.
Yeah. Okay, this is, we already saw the active and passive scorecard. Yes, this is interesting. Look at the alpha shrinking. So this is the trend. Okay, so this is the just 1 point number of June 2021. So this may not give you how is actually trend happening. This report gives you trends happening in across categories, large, mid, and small. So large cap, this red line shows that how many percentage of fund managers are underperforming or outperforming. So you can see very small percentage of fund managers outperforming. This is based on 5-year return. Okay. So this trend has been declining, especially after 2018 when this categorization happened. Okay, mid still there are 40% funds are outperforming. Okay, in 5-year terms. Small cap still there are 90% funds are outperforming. But as market will mature, you will see this also will show underperformance. But this is the trend which you can see very clearly.
Exactly, as we discussed. So mid cap and small cap still have some scope in generating alpha as compared to large cap funds.
Yeah, but this is again history, right? Now you will be investing today for next 10 years or 5 years.
Right.
Okay, so that's where the trend will again persist, and you will see this performance will come down. So okay.
Indeed. So now it is no longer too soon to talk about passive investments in India. Basically, it has come across basically the passive market cap size.
This is an interesting analysis done by Mahavir and his team. There's an internal research. I will take time to. I'll take 1 minute to explain you what is this exactly. So look at the headers here. There is a dark and light line shadowed. You can see large cap, large and mid cap fund, small cap, focused, multi cap, ELSS, and this is so on and so forth. Okay. So these are, and we have also mentioned this horizontal line which you see. These are the indices or benchmark. Okay. So the light blue is Nifty 50. The light purple is Nifty Next 50. Okay, let's understand one category, you will understand the other. So let's look at only large cap category. The point here is these yellow dot lines are active funds, active schemes, mutual fund schemes, who are benchmarking these indices, Nifty 50 and Next 50. Okay, and their 3-year performance as of July 2021. So you can see if the line is above, this dot is above this light blue line, that means it is outperforming. And below this line, that means it is underperforming. So you can see Nifty 50, there are only 1, 2, 3, 4, 5, 6, and you can take on the line 7, 8 only funds are outperforming. Rest all funds are in 3-year category are underperforming. Okay. Same thing, large and mid. Large and mid means top to 250 stocks. There also you can see most of the active funds are underperforming. Mid cap, you can see 50-50. So few guys are underperforming, outperforming, few guys are underperforming. Small cap, yeah, some more number 60-40 you can see guys are outperforming and 40% are underperforming. Focus fund, now this is a very interesting index. Nifty 500. Nifty 500 is actually is known as the total market index, where you are actually investing in almost 94% of the market. There are few categories like focus fund, multi-cap fund, ELSS, they are using this as a benchmark. And you can see almost only 3 funds are outperforming this segment. Now, let me draw a line from here. If I draw a line from here to here, what does it mean? You can see there are very few dots above this line and almost 90% dots are below this line. So Nifty 500 represents the total market, that if you don't know what to buy, just buy the total market, where you are buying actually large, mid and small all together. This is also an index, and index funds are available on this index. Okay, so most of the guys are underperforming this index. So when you buy an entire market, it is said, when you don't know what to do, buy entire market. When you buy Nifty 500, you will see, 90-95% funds are underperforming. This is in case of Indian domestic, and you can see Bank Nifty, which is a sectoral fund also. Let's look at another category, which is global. So there are global funds which are available in India, and there are two benchmarks, NASDAQ 100 and S&P 500. Index and index funds are also available on this. NASDAQ has outperformed all global funds, and S&P, as this is S&P line, still there are 1, 2, 3, 4 funds are outperformed. But a lot of spaces. So the global numbers, which also somebody said, that globally it is already been proven that active funds are not doing well. And same thing you can see when it comes to total market index, most of the categories are underperforming. And this is a great job by Mahavir and his team. Yeah, so we'll move forward. So I think that's all. Last slide for me. So exactly, let's understand why this is happening. So first of all, there is something called luck versus skill. So if I have to outperform market consistently, I have to perform and I have to be skillful to actually repeat my performance, repeat my skill. When skill is something when I can repeat something, but though I am skillful, but if I am not able to repeat, okay, so all athletes you will see, they will repeat, and they will repeat, 99% of the time. Okay, but you saw these guys were entering into BSc ring, and they were praying to their god Ganesh, so that today I should be lucky. So that is the problem with the guys. There are so many active guys. The market wisdom is so powerful that you have to be lucky, and that's where the 40% number which you saw, or that 13% number which you saw, the guys were outperforming. You are not sure whether the same guys will consistently stay in that range. Okay, so there will active passive will always remain, but you are not sure whether this year you will be lucky, or next year somebody else will be lucky. Okay. So that is why skill can be replicated, but luck, since your performance cannot be replicated, that means it's not a skill, it's actually a luck. Increasing market efficiency, we saw, so many mutual fund insurance companies are making market so powerful. Change in fund manager style, change in fund manager. In fact, fund manager they are doing job, right? So they leave after 10 years, 20 years, and that's where you see fund performance affect a lot. The style of investment also changes, growth to value, value to momentum, and all. Concentration to some of the sectors and their biasness about a particular stock or sector, that also helps, or sometimes it works the other way around. And high portfolio turnover, churning, and cost associated with. So cost and high portfolio churn actually kills your portfolio. This silent poison, which actually doesn't, it's not noticed by investors, but that is proving out to be as market is becoming mature. Okay. So I think that's all we have for active and passive. Any questions here? Jolly, would like to, shall we take questions here on this segment, or you want me to complete the second part?
Yes, we can do that. There is one question. And then if we can, there is one participant, Mr. Ishwar, and then if we can unmute him. Or actually, if you can post your question in the Q&A box, Ishwar, that will also do. Okay, maybe we can take it towards the end of the session.
Right.
Sure. I'll proceed. Okay, so this is all about, what are the challenges faced by active managers, which leads to underperformance. Okay, let's look at now. This is about active and passive, though both of them exist together, but passive plays a huge role in your portfolio. You should be having at least 50% of your core portfolio in passive, and on top of that, you can have your active strategies to generate an additional alpha. Okay, that is how globally it goes as well. Now let's understand, when we talk about India market, we just spoke about India market, right? India's GDP contribution to the world is less than 4%, and India's market cap globally is just 3%. So when you invest in India, you're losing out 97% of the opportunities which are available outside India. So whether you do large cap, mid cap, small cap, PMS, AIF, you're only restricted to 3% of the global market cap and 4% of the global market GDP, global GDP. Okay, so let's understand, does it make really sense to go for international? Yeah, so this is what the market concentration. So you see US itself is 60% of the global market cap. Okay, and then developed market, which you have the Europe, Far East, Australia, Japan, UK, you have 28%. And emerging market, where India is also part of emerging market, which is just 10%, and in 10%, India is just 3%. So globally, India is just 3%. So you are, a lot of opportunities are outside India. So definitely, it makes sense to look at outside India as well. Let's look at why you should look at. So definitely, global exposure to global markets, you get a different market altogether, because we are still a emerging market. The US markets are very developed market. There are a lot of other emerging market which are growing much faster than India. Diversification, this is a very interesting factor. We'll cover in next slide also. Low correlation. So there is something called, how do you select an asset class? Why debt and equity go hand in hand? Because they have a very low correlation. They behave very differently in different market scenario. Same way, when international markets are compared with Indian market, they also have a very low correlation. That makes it another asset class. So when you look at your designing your portfolio, it is not only debt, equity, and gold. It should have debt, equity, gold, and international also. Okay. Participation in regional, Larry, you will see sometimes some of the countries doing really well. That's where it helps you to have an international portfolio. Global brand, the brands, if I can talk about from Apple to your Sony to your ASML, these all have become global brands. Why they shouldn't be? Because they are making revenues globally. Okay, you can't say Volkswagen only making money from Europe. They are making money from India also and other countries also. Why not? They should be in my client's portfolio or my portfolio. New sector exposure. India is dominant by financial sector. So you go to Europe and developed market, you will see consumer sectors are very high. Go to US, you will see IT sectors are very predominant. So you will get exposure when you go to different markets. Something very important, along with the stock performance, we also get dollar return or the currency return. So when currency valuation goes up, USD becomes strengthened, your portfolio return go up. So there are dual asset classes return you get, the equities as well as the currency. And tax efficient, these are all treated as debt taxation, but returns are better than debt taxation. If you wait for 3 years, your returns are better off than our Indian equity also, or debt also. Yeah. This is what we see. Guys keep changing. So this is the last 10 year you can see very clearly. 7 year US was #1, then India was also #1 few years. Emerging markets was #1. Okay, developed market was also doing pretty well, but we never invested. So these guys keep changing. Okay, so you should have a portfolio of mix of all these 4, or you can go to different select markets as well. And there are opportunities available in India also now. Okay. This is what we get. And these brands are making money. Our TV has been replaced by Netflix and Amazon Prime. Okay, if you think of a computer, you can't think of without a Microsoft or Apple. Your computer need to have Intel Core chip, right? Your online payments, your electronics like LG, Samsung, the car brands, all these brands have become global brands. And when if they are growing, why not? They should be a part of our portfolio. This is very interesting. When you go to international, we just saw how it is difficult to beat a domestic market. Internationally, we don't know a lot of things. We don't know which stocks to buy. We don't know which sector to buy, what will do better, what will not do better. So internationally also, we recommend that you should go through a passive route. And this is an example. Let me explain you what is this. So in last 10 years, how sectorial movement has happened in S&P 500 index. So you can see here, there's a dark blue line on the top here where the new sector, which is real estate, has been evolved. You can see the communication sector, this is the light blue line this ink blue line is actually gone up. Okay, then your IT sector, this is the green one, which is also increasing drastically. The energy sector, which was very drastically, now it has reduced to 2.5%. Okay, so index is the beauty which automatically manages itself as economy grows or as the market grows and matures. So that's why index is ideal representation of a particular country and economy, what is happening in that country. Okay, so don't have to worry about when you buy. There is index committee which will automatically put stock out and in of the index, and automatically your portfolio gets a fresher stocks or new stocks or high performing stocks. Yes.
First, I would just, because we have overshot the time, so if we can have the presentation covered in the next 3 to 4 minutes, so that we can also spend some time on questions.
Yeah, I think I will take another exactly 6 minutes.
Okay, great.
We're finished, yeah. Yeah. So yes, any this is another question. What would be the correlation of US market to Indian market? I just mentioned this number in one of my previous slides. So if somebody was attentive, definitely will be able to answer better. So both these markets, how do they behave? Closely, or so if you have higher the percentage, that means they are very closely, lower the percentage, that means they are less likely to closely. Okay, can we have the results? Yeah, results please. Shall I move to next slide? Okay, let the result come in. Oh, okay, result here. Yeah. Oh, sorry, it is gone away. Can we again see this? Yeah, it's right. It's visible, right, for everyone? Yeah. Okay. So you can see most of the guys said between 30 to 50%. Okay. Okay. And a few guys said less than 50%. Let's see this in the next slide. So we have a number. Yeah, here it is. So when you see equity market, US markets are less than 20%, which is an S&P 500. Developed market ex US slightly higher, and emerging market, yes, because India is also emerging market, it is higher. Okay, so that's the number for your record. So when you go to US, you're actually buying a different US and developed markets, a different country altogether you're buying. Yeah, so what is the global share? It is how it is growing. So globally, 2010, you say only 14% people globally investing in US in passive, and US only 19%. Now we see 40% in US and 31% globally. So it's actually growing across the globe, the passive investment. Yeah, we saw this PIWA report in previous slide, you know, how guys are performing. So you can see these numbers are replicating every year, every continent. So what is happening exactly is the active share is moving to passive. So outflow of active is actually moving to passive. Okay, so globally it is all 50-50, which I just mentioned at the beginning of my presentation, that it is happening 50-50. It is not like, you know, entire world is moving toward passive, but globally or internationally, the passives are the mutual funds are not actives. Mutual funds are only passive, and active means alternate strategies. Okay, so they use very hedge funds and all to generate alpha. Yeah, so why use international? Very easy. You exactly know. If you don't know about US, just buy US index. If you don't know about Europe, you just buy Europe index. If you don't know about emerging market, just buy the emerging market index. Okay, economic direct investments have some costs which are not known, but when you go through a mutual fund route, you have a very economic cost. The cost is not more than 1% here when you go through a passive route. Diversification we just saw, and again we just saw the numbers. It's hard to beat an index globally also. Yeah, so the last couple of my slides here, we have created one portfolio, and it is in the same of the global market caps, and let's look at how it has performed as compared to Indian market. So here, how much weightage you should have in international portfolio in equity in your equity portfolio. So let me explain you this. This dot which you see here is 100% equity, domestic equity. Okay, and as you go on adding international, what happens? So the x-axis is your risk volatility and y-axis is your returns. So as you move towards y-axis, you can see your risk is drastically coming down when you add international, and your returns are also improving. Of course, your returns are only few basis points, but these are 15-year CAGR return. Huh? This is a very long-term period. This is not a short period. So it's not mentioned here. I know it's a 15-year period. As you go 20%, your further risk goes down, your return improves. Okay, as you keep on increasing international, the data shows that between 20 to 40% is something which you have of your equity portfolio international. You add substantial returns, at the same time you reduce substantial risk. Look at from 21%, 21.5 to 17, almost 25-30% of your 22% of your risk comes down, and your returns also improves. So this is an internal study that we have done. Yeah, 1500 mentioned here. Okay, so this is the number that one should have in the portfolio. My second last slide, let's look at in the number terms. How does it look like? So when you look at India, this is what India market has performed. You've taken Nifty 500. Okay, as you go on adding 20% global portfolio, 30%, 40%, what happens? Okay, so 1 year period, you might see returns are dropping because India was at the bottom last year, September. That's why you might see India doing really well. But as you go longer term, you can see when you add international, your returns are improving, and at 40%, your volatility risk is very low, and also returns are improving as compared to standalone equity market, the domestic equity market. So that's where it makes sense why you should have an international portfolio in your equity portfolio, domestic portfolio also. Yeah, we saw these returns. Reason remains same: market efficiency, change in fund manager style, and high portfolio churn and cost associated with. Some of the thoughts from gurus, they talk about, Charles Schwab says 75% of funds investments are in index funds. Warren Buffett, all his annual report, he mentioned that most investors are better off in index fund. Miller Merton says, if you do a coin switching, okay, you will see that most of the guys are not going to do at all. They do it just by chance but not with something really with their skill or outperforming. Benjamin Graham says it is not the returns what we manage, but is a risk, and risk can be managed very well through passive funds and index funds. This is my last poll, and we like to stop here and take questions. How do you think that behavioral biases affect you? Do you think what are the things that we do which affects an investor? Okay, can we have the poll answers, poll results? Chasing past performance. Wow, fear of missing out. Exactly. So when we actually look at chasing past performance, that's where it actually helps you. But there is something more to it also. Let me go to, oh, sorry. So Mahavir, due to lack of time, we will actually shift to the last poll, and then we can take questions. Okay. So Peter Lynch also, all his throughout life, he did active management, but when last 5 to 7 years of his retirement, it was very difficult for him. He could not outperform S&P 500, and that's where he mentions, okay, it's better off an passive fund manager. Okay. My last poll, and then we'll stop here. What could be the difference between investment return and investor return? Okay, let me explain you what is this. Can we have the polls? Last polls. Yeah, investment return is something which we see a market return, and investor return is actually something what we get in our portfolio. So we see Nifty has gone 62,000, so Sensex has gone 60,000, but we don't see that return in our portfolio. So that's called an investor return and investment return. Can we have the poll results? Yeah, poll results can we have? Wow, more than 4%. Oh, more than 4%. Yes. So let's see how much it is. Yes. So actually 4.25%. So what does this? Why does this difference happens? Because of behavioral management, investors get in and get out of the fund. They think it's a right time to stop a SIP. It's the right time to book profit. It's right time to issue. Markets are lower, so you should not participate in the market. And that's where a big pie of returns are being taken by just investors' behavior. Let's call behavior gap. So time in the market is very important. Just look at, just do your goals, set your goals, and if your goals are set, and if you assess your risk, that's where you make reach out your goal by investing regularly in the market and not allow your behavior to affect your investment portfolio. So that's all from our side.
Thank you, Vikash. Thanks a lot. It was very insightful indeed.
Pardon me for getting slightly going overboard.
That's okay. That's okay. It has been very insightful and informative for all of us. We have answered a couple of questions. Basically, they have been addressed by Mahavir in the chat window. There's one more question that we need to address. This is basically, which is a better passive investment vehicle, whether it is ETFs or index funds, especially for tracking error and taxation in dividends and capital gains.
Yeah, so for taxation, dividends and capital gains, both are same. ETFs are very popular globally because they have a tax advantage there, tax arbitrage. That's why ETFs are very popular. Here in India, ETFs are not very popular because of liquidity. Okay, so most of the, and if I ask about tracking error, ETFs will definitely have a lower tracking error, but theoretically, an index fund will have a slightly higher tracking error. But if you look at the illiquidity of ETFs, you end up paying same cost. Okay, so we recommend that index fund, till the time ETF actually grow a lot of popularity in India, index funds are a better option for our retail investors, for anybody, because it's very easy to buy. You don't need demat account, trading account, and very convenient option to trade in or buy and sell in that. So index funds are better options here. Our risk adjusted returns in the slide are Sharpe ratios. So what we have taken, Sharpe ratios are different. The risk adjusted returns are basically your standard deviation. Okay, Mahavir can come in of this formula.
Yeah. So it's a very simple one. It's a kind of a Sharpe ratio, but in Sharpe ratio we reduce the risk-free rate, which doesn't happen in this one. When we calculate risk-adjusted returns, it's simply CAGR of a certain period divided by the volatility of the same period. So for example, if I'm calculating 3 years risk-adjusted return, I would take 3 year CAGR divided by 3 year standard deviation of the same period, so same fund of the index. I hope it helps to understand that.
So basically 53.2 is divided by 12.9. That's where you get this.
Exactly.
Correct?
Exactly.
Yeah, it's very simple. So
yeah,
16 divided by 18, this is where you get this number.
The idea behind this standard statistics is basically to help investors understand that how much return you earn per unit of risk taken. So like as Vikash pointed out, in the example where 53.2% is a CAGR divided by annual risk, the volatility is 12.9. Investors are getting 4 times the return of the risk they are taking for every 1 unit they take a risk.
Yeah. Any further questions?
No, I think we have addressed all the questions. I think people were also asking about sharing the presentation. So Mahavir, if you can address that.
Yeah, we will share the
That
presentation.
will be shared in the post mail.
Right.
So thank you, Vikash. Thank you, Mahavir. Thanks a lot. It has been really insightful for all of us. And we'll be more informed, I mean, after this presentation. This is basically a reminder for everyone. If there is evaluation survey on your screen, so please complete it and provide us with your valuable feedback. Thank you everyone for sparing your time. And lastly, but not the least, Anlin and Harshad, also thanks a lot for facilitating this conversation, this webinar for all of us. Thank you, and see you at our next webinar very soon. Thank you so much.
Yeah.
We have to also thank Annalyn, her Jolly, and the entire team for putting a lot of efforts. I should say that these guys are doing too many things backstage, to get a very good presentation without any flaws, without any issues. Good job, Jolly and Annalyn. Thank you so much. It was a nice experience working with you guys.
Thank you. It was nice
Thank you.
interacting with both of you. Thanks a lot.
Yeah.
Have a nice day. Thanks.
Yeah.
Bye.
Thank you. Bye.